Shorting the market. How to profit when the market plummets. Have you ever felt frustrated when the market suddenly crashes, your portfolio turns red, and the only thing that stays green is false hope? Well, in this highly volatile crypto world, the market can rise and fall like a roller coaster. But the good news is, we don't always have to profit when the market is rising. In fact, for traders who understand the strategy, shorting the market can be a secret weapon for making money, even when the market is in turmoil. But hold on, shorting isn't just about pressing the sell button and hoping BTC crashes. Nope, shorting requires the right timing, sharp analysis, and a resilient mindset. One wrong move, and instead of profits, you might end up getting liquidated. The pain isn't just in your wallet, but also in your mental state. That's why, in this episode, we'll have a casual yet in-depth chat about how to increase trading success when shorting the market. It's not just theory, but also practice, so you can know when the right time to short is, how to protect your spot position, and why shorting is ideally not for wild speculation, but for a smart hedging strategy. And don't worry if you're new to shorting, it's okay. We'll cover everything from the basics to the strategies used by professional traders. So, grab your coffee or tea, turn on your focus mode, and let's start with the most important foundation. Chapter 1. Wait for the market to enter a phase of euphoria. Why should you wait for market euphoria to short? Here's why. Okay, let's start with the most basic question. When is the most ideal time to short the market? Many people just guess. Is the market red? Short immediately. Is BTC correcting slightly? Short immediately. Altcoin drops 5%. Short again. But shorting isn't about guessing price direction. It's about understanding market psychology. And the biggest mistake novice traders make is they short too quickly when the market is still in the fear phase or even neutral. Actually, it's the opposite. The best time to short the market isn't when everyone is afraid, but when everyone is too confident. Welcome to the land of euphoria. What is the euphoria phase? Imagine you're hanging out in a crypto group, and suddenly everyone becomes a self-proclaimed analyst. All charts are predicted to go to the moon. All coins are considered still cheap. Influencers start saying, Bitcoin to 100K this week, rocket. FOMO explodes. The fear and greed index hits extreme greed. And everyone believes this time is different. Yes, this is when we need to be cautious. Why? Because history has repeatedly taught us. Mass euphoria often signals the market is nearing its peak. And if you short at the peak of euphoria, the potential profits can be much higher. Not only because the price is already overvalued technically, but also because market psychology is starting to weaken. People are too confident and not mentally prepared if the market reverses direction. Euphoria indicators. Use data, not feelings. How do we know the market has entered the euphoria phase? Here are some signals you can track. 1. Fear and greed index. Check this indicator regularly. If it hits 80 or above, extreme greed, be cautious. That's a classic euphoria signal. 2. Funding rate in the derivatives market. If the funding rate for many coins is very positive, it means many people are opening long positions. What does this mean? The market is becoming crowded in one direction, and that could be a sign of a reversal. 3. Sudden surge in volume without a clear catalyst. If transaction volume suddenly spikes drastically without any major news, it could be driven by FOMO. This is the right time to prepare for shorting. 4. Unreasonable price increases. If a random coin's price jumps 200% in a day just because it's trending, that's not analysis. It's euphoria. Shorting during euphoria equals counter mentality. Shorting during the euphoria phase isn't just a technical strategy, it's also a mindset. You have to be ready to go against the flow, against influencers' opinions, and sometimes against your own thoughts. Remember, when others are greedy, we must be cautious. That's a classic principle from Warren Buffett that's still highly relevant in the crypto world. Conclusion of Chapter 1. If you want to short the market with a higher chance of success, don't rush. Wait until the market is overly greedy, until the fear and greed index screams extreme greed, and everyone is convinced prices can't possibly fall further. Because it's precisely at that point. Shorting isn't just a strategy, it becomes a smart, proactive move. Chapter 2. Look at the macro situation. Macroeconomics, an important key before you short the crypto market. Now let's be honest. How many traders short the market without thinking about what's happening in the real world? There's all this talk about interest rate cuts, falling inflation, or announcements from the Fed, but they're busy opening short positions just because the chart looks bad. The thing is, the crypto world doesn't exist in a vacuum anymore. It's deeply interconnected with global macroeconomic conditions. What does that mean? If you want to short the market accurately, you can't ignore the macro picture. Crypto and macro, a love-hate relationship. Back then, people saw crypto as a wild, rule-free world. Anti-banks, anti-Fed, just free. But now, every time Jerome Powell coughs, Bitcoin prices can drop by 3%. Why is that? Because big money, from institutions, hedge funds, and heavyweight players, has entered the crypto market. And they make decisions based on the macro outlook. They don't just look at charts. They look at inflation, interest rates, GDP, geopolitics, and global liquidity. So if you short the market without understanding the macro conditions, it's like riding a motorcycle on a highway, but with your eyes closed. Dangerous, boss. What should you pay attention to? Here are some macro indicators and events you must monitor before hitting the short button. 1. Federal Reserve policy, interest rates. If the Fed is hawkish, meaning it's inclined to raise interest rates, risk markets like crypto typically drop. But be cautious. If the market has already priced in the effect, the impact might be minimal. Shorting when the market hasn't priced in the negative effect equals potential for big profits. 2. Inflation data, CPI, and PCE. If inflation drops sharply, it could be bullish for crypto. Shorting in such conditions equals not ideal. But if inflation rises despite expectations of a decline, boom, the market could turn red. 3. Geopolitical events and global crises. War, major conflicts, energy crises. All of these can trigger capital outflows from risky assets. If global sentiment is poor and investors start seeking safe haven assets like the USD or gold, shorting crypto could be a logical strategy. 4. Global liquidity. Have you heard of the term QT, quantitative tightening? If central banks are withdrawing liquidity from the market, it means money is getting tighter. And the crypto market desperately needs liquidity. Low liquidity? Prices can easily plummet. A perfect situation for shorting. Don't short during bullish signals. This is often overlooked by many people. Sometimes there are major events that should be bullish, but because people are eager to short, they end up taking positions opposite to the macro trend. For example, a new Bitcoin ETF is approved. Major countries legalizing crypto. Significant global interest rate cuts. Massive stimulus packages released. If you short during such events, the market might surge instead, and you could get liquidated within hours. Shorting isn't about guessing the market will fall, but about identifying when the market is vulnerable to a decline. Shorting requires context, not instinct. Successful shorting isn't just about technical skills. It's about understanding the full market context. And that context isn't complete if you're only looking at a 15-minute chart on TradingView. Take the time to read economic news, listen to central bank speeches, or check the weekly economic calendar. Because when you understand the global context, you can determine, is the market globally overbought? Is there potential for negative surprises this week? Are the big players preparing to exit market risk? And from there, you can make a well-reasoned shorting decision, not just based on a hunch. Chapter 2 Conclusion. Shorting without considering macro conditions is like fishing in a drained pond. It looks calm on the surface, but it's empty below. But if you short with clear macro signals, you're not just playing it safe. You're playing in the most strategic zone. And that's the difference between an ordinary trader and a professional trader. Chapter 3. Wait for the market to retest. Shorting the crypto market? Never enter before a retest. Okay, listen carefully. If there's one common mistake traders often make when shorting the market, it's entering too quickly. Seriously, the first red candle appears. Immediately FOMO. Immediately short. And a few hours later, the market makes a V-shape. The price goes back up. Your account? In the red. No matter how good your analysis is, no matter how sharp your intuition is, if you can't wait for the retest, you could become the next victim of a fake out. What is a retest and why is it so important? A retest is essentially a retest of important price levels. Whether it's a support level that's just been broken down or a resistance level that's just been broken from below. The purpose of a retest? 1. To determine whether the breakout or breakdown was valid. 2. To provide confirmation before taking a position. 3. To offer an entry opportunity with a much more reasonable risk-reward ratio. The key: shorting isn't about guessing. It's about waiting for the golden moment when the price has spoken clearly. Simple example: breakdown plus retest. For example, Bitcoin drops from a strong support level at $60,000 and breaks below it. Traders panic. They immediately short. But often the price will bounce back to $60,000 for a retest. And that's where the ideal short entry point appears. Why? Because the price has confirmed the breakdown. Market structure shows weakness, and you enter at a higher price, better, with a tight stop loss. The result? If the market actually drops, you get the best entry position. If it turns out to be a false breakdown, your SL isn't too far away, minimal loss. No retest equals entering in the middle of chaos. If you short when the market is just starting to fall, you're actually entering in the middle of an emotional reaction. There are still panicked buyers who can push prices up. There's still liquidity that hasn't cleared. And the worst part? The market can trap all shorters and cause a short squeeze. That long red candle could turn into a green candle in 15 minutes. And that happens more often than we think. Retest is an emotional filter. Why do pro traders rarely panic? Because they understand one important thing. Patience is a strategy. A retest is the market's way of saying, hey, calm down, ready to trade with a cool head? If you can wait patiently for the retest, it means you're trading with logic, not with emotions or momentary impulses. And that's precisely what helps you survive longer in this market. Checklist before shorting. Wait for the retest first. Before you click the short button, ask yourself this. Has the price just broken down from an important support level? Was there high volume during the breakdown? Has the price returned to that level for a retest? Has a confirmation candle, e.g., a rejection candle, appeared in the retest area? Does the risk-reward ratio of this entry make sense? E.g., 1:2 or better. If all the answers are yes, go for it. If not, hold off. Grab a coffee. Check back later. Retest equals quality entry. If we use a military analogy, shorting without a retest is like attacking the enemy without knowing their numbers. But shorting after a retest? That's like attacking after drones provide full intel, snipers are in position, and the enemy is starting to let their guard down. The bottom line: a retest lets you enter with full confidence and careful calculation. Bonus tip: use the right time frame. Valid retests typically appear on the 1H, 4H time frame. If you're too focused on the 5-minute chart, you might miss a lot of noise. Chatty suggestion: use a combination. Daily chart to see the big picture. 4H to identify key levels. 1H to spot entry signals from retests. Chapter 3 Conclusion. Shorting crypto isn't a race to see who can make money fastest. It's the patient ones who get the cleanest entries. Remember, the market is like a Batman trap. If you're too aggressive, it gives you false signals. If you're too cautious, you'll miss the opportunity. But if you wait for a retest, you're like a sniper waiting for the target to appear in the scope. Once you pull the trigger, boom, the target is hit. Minimal risk, maximum reward. Chapter 4. Shorting only for hedging. Hedging strategies when shorting crypto. Don't lose twice. Okay, let's dive into a topic that's a bit technical but extremely important, and one that many retail traders completely misunderstand. Namely, shorting the market isn't for show. Shorting the market should ideally be a hedging tool, not your primary strategy if you don't have any spot positions at all. The problem: many short without spot. This is a real-life scenario. Someone sees Bitcoin seems like it's going to drop, so they open a short position. But they don't own any Bitcoin at all. No ETH, no altcoins, and no exposure to the spot market at all. What does that mean? If the market ends up rising, they incur a net loss. There's nothing to offset or cover the loss. And when they close the position with a loss, everything is gone, without any compensation. Shorting is ideally for protecting the assets you own. Now, compare that to this scenario. You have 1 BTC in the spot market. You're confident the market will correct within the next 1 to 2 weeks. Instead of panicking and selling your spot position and losing long-term potential, you open a short BTC position in futures or margin as a hedge. If BTC prices actually drop, your spot value does decrease, but your short position profits and offsets the spot loss. If BTC prices rise instead, your short position might hit a stop loss, but your spot BTC value also increases, meaning you still hold valuable assets. That's the essence of hedging. Protection, not speculation. Hedge equals temporary insurance. Imagine it like this. Hedging is like buying insurance for your motorcycle before the rainy season. You don't expect an accident, but you're prepared if flooding occurs. Similarly, you don't expect the market to crash, but you open a short position to be prepared if a correction does occur. And the good news? You still hold spot assets that have the potential to rise in the long term. Long-term trader mindset versus short-term speculator mindset. Long-term traders understand that shorting is part of risk management. It's not the primary tool for making profits. They focus on the growth of spot assets, like Bitcoin, ETH, SOL, and others. And shorting is used temporarily when the market shows weak signals. On the other hand, short-term speculators? Shorting is seen as the fastest ninja way to get rich. But if you're wrong, margin calls don't ask questions. Simple simulation, hedging versus speculation. Example, you have $10,000 in ETH in the spot market. You open a short position worth $2,000 in ETH when there are correction signals. Scenario 1. ETH drops by 20%. Your spot value drops to $8,000. But your short position can profit around $400, depending on leverage and entry. Scenario 2. ETH rises by 10%. Your short position incurs a loss, but your spot value increases to $11,000. Overall, you still make a profit, only incurring a small loss on the hedge. This is what's called a defensive strategy, not a quick profit-seeking strategy. What's the ideal percentage for hedging? Not everyone is suited for a full 1:1 hedge. You can start with 10 to 30% of the total spot value. Use low leverage, maximum 2x, 3x. Have clear stop loss and take profit levels. Don't hedge all in. If you're shorting everything, that's not hedging. It's gambling on market direction. Risk of shorting without hedging, double losses. This is an important point and deserves repetition. If you short the market without holding the spot, you can 1. Lose due to the short position being liquidated. 2. Miss out on the market's upward momentum. 3. Feel stressed because you have no reserve assets to breathe. Meanwhile, if you short as a hedge, you still hold the asset, and the short position is merely a shield. In fact, sometimes you don't need to hold the short position for long, just enough to get through the temporary bearish phase. Short with strategy, not with ego. If you short because you want to beat the market, sooner or later you'll lose. The market isn't your enemy. It just moves up and down based on collective emotions and fundamentals. Short with the purpose of protect your wealth, manage portfolio volatility, and keep your long-term positions safe. That's healthy shorting. Chapter 4 Conclusion. Shorting isn't the main weapon. It's a protector, a backup plan, and a risk management tool. If you don't have a spot, shorting is like fighting a war without a fortress. If the market suddenly turns bullish, you run out of ammunition and have no place to hide. But if you short while holding a spot position, you have two weapons. One for attacking, short, one for defending, spot. And this is the kind of strategy that usually wins in the long run. Don't short randomly. Don't trade without a purpose. So now you know, shorting the market isn't just about clicking the red button and hoping the price will fall. It's about timing, market conditions, macroeconomics, and risk management. Shorting isn't for those who like to guess. Shorting is for those who have a plan. And in this increasingly chaotic market, where new ETFs launch every week, FOMC meetings happen, and drama unfolds on Twitter, the traders who survive and thrive aren't the most aggressive, but the most prepared. Not the ones who are best at guessing the direction, but the ones who are most disciplined with their system. You might be wrong about your position. That's normal. But if you're wrong about your mindset, well, that's what slowly bleeds your account dry. Use short selling as a tool, not a lifestyle. If you still often short the market without a clear reason, ask yourself, what's my goal? Do I have a spot? Am I mentally prepared if the market reverses? Because successful short selling isn't about luck. It's about patiently waiting for the right moment. It's about being mentally prepared if the market doesn't go as expected. And it's about understanding that sometimes doing nothing is also a position. Remember this message. Shorting isn't about being a hero. It's not about showing off in a community group. It's also not an escape from the fear of missing out on opportunities. If you want to survive and thrive in the crypto world, you need more than just a gut feeling. You need a system. You need a process. You need discipline. And most importantly, you need principles. 5 core rules of Mr. Suw Crypto, new style version. Before we wrap up this episode, as usual, I'll remind you to always hold on to these 5 core principles, so you stay sane, keep making profits, and can sleep soundly. 1. Cold money only. Don't use household funds or loans. 2. Avoid overleverage. A small capital isn't an excuse to be reckless. 3. A healthy portfolio is 70% Bitcoin, 30% altcoins. Don't reverse it. 4. Always have cash on hand. Not for show, but to buy the dip. 5. Play the long game, because those who rush usually end up battered. If this episode helps you think more deeply about shorting and trading strategies, don't forget to click subscribe, share it with friends who often FOMO short when the market drops, and leave your comments below. I'm Mr. Suw. See you again in the next episode. And remember, in the crypto world, patience not only brings profits, but also peace of mind. Peace out, victory, and